Welcome back to The Deep Dive. I'm Wendy.
And I'm John.
We're both staff here at WeWire, and, we spend our days deep in the source material, making sure that the weekly Stay Wired recap you get is built on solid ground.
Absolutely. And this week, Wendy, we're looking at something pretty fundamental, wouldn't you say? A big shift happening in global finance.
Definitely. And it's not happening in fancy bank towers, but, right on people's smartphones.
Yeah, it really boils down to a question of trust, doesn't it?
Yeah.
Where do you actually put your money when your own government's currency is, failing you, actively failing?
That's exactly the core crisis we're digging into today, and our sources really hammer this point home. Listen to this. In high-inflation economies, from Nigeria to Argentina, local currencies are losing value fast. Nigeria's consumer prices, for instance, hit 21.9% year-on-year back in July 2025.
21.9%, just think about that.
And it's not just Nigeria. Many African currencies have weakened dramatically.
That kind of volatility, it just creates, financial terror for ordinary households. It's hard to overstate.
So our mission today is to unpack how these blockchain-based stablecoins, the big ones like USDT, USDC, how they're kind of stepping in to replace traditional dollar savings for everyday people in these really volatile places.
Yeah, we often think of crypto as like pure speculation, right? Wild swings.
Exactly. But the data we're seeing paints a completely different picture here. Okay, let's unpack this. So let's start with that trust vacuum you mentioned. What exactly is pushing savers away from their local money?
Well, it's like a perfect storm hitting these emerging markets really across the globe. You've got two big forces working together, basically destroying wealth.
Okay.
First, there's that chronic, just crippling inflation. We mentioned Nigeria near 21.9% mid-2025, but it's way higher in other places. It basically acts like a hidden tax, just melting your savings away day after day.
Right. And when people see their money disappearing, they try to get out, obviously. And the government sees that.
Exactly. They panic. And that brings in the second force. The government's reaction. They slap on strict foreign exchange controls, FX controls.
Trying to hoard the dollars they have left?
Pretty much. They try to manage the scarce supply of dollars, which makes getting a legal dollar account almost impossible for regular people. Or if you can get one, it's so expensive through the official channels that, small businesses, individuals, they just can't afford it.
So no safe haven in the local currency and no easy way to get into the traditional safe haven, the US dollar.
Precisely. That combination, high inflation plus restricted access to dollars, it just creates this massive void, a vacuum of trust.
And that void, that's where the digital dollar, quote unquote, steps in. We're talking stablecoins here. These are crypto tokens pegged supposedly one-to-one to the US dollar. They claim to be backed by reserves.
So they function like a digital bank account, but in USD, and crucially, outside the local banking system's control.
Yeah, and it's not just us noticing. Morgan Stanley pointed this out. They observed that in these kinds of environments, stablecoins, and I quote, are often considered a store of value protecting against local currency depreciation.
Right. And here's where it gets really interesting, I think. You might ask, okay, aren't these private tokens risky too? And yes, of course, they carry their own risks. We know that.
Sure, reserve backing questions, platform risks.
All of that. But for these users, the utility, the immediate benefit they offer seems to outweigh that perceived risk. These stablecoins, they mirror the strength of the US dollar, giving people a hedge. But the really critical part, it's the access.
Access, meaning?
24/7 liquidity, instant access through just a basic smartphone app. Think about if you're a small importer in Lagos, Nigeria, you need to pay for goods arriving maybe tomorrow. The Naira is crashing daily. You simply can't wait 3 days, maybe longer, for the central bank to approve your request for dollars, assuming they even approve it.
Right. You need it now. You need reliable, instant liquidity.
Exactly. The immediacy is key. It bypasses all that bureaucracy that's actually designed to restrict your access in the first place.
So people are making a calculated trade-off.
Correct. They're essentially trading one kind of risk,
Yeah.
Their sovereign currency collapsing and facing FX restrictions for another type of risk, the questions around stablecoin reserve management and platform stability. And for millions right now, that first risk, the one they live with daily, feels much, much scarier.
Okay, that makes sense. And we really see this calculation playing out when we look at the adoption data coming out of Africa, right? This is where the story just flips completely. It stops being about speculation and becomes about, economic necessity.
Oh, absolutely. The Chainalysis study we looked at provides some just astonishing context here. Get this. Nigeria alone received roughly $92.1 billion in crypto inflows over just a 12-month period.
92 billion in one country.
92.1 billion. You really need to let that number sink in. It's nearly 3 times the crypto volume seen in South Africa during the same period. And South Africa, has a much more stable currency, more developed financial system.
So what's driving that massive volume in Nigeria?
It seems to be driven almost entirely by survival, by hedging against that relentless inflation and the difficulty of getting foreign exchange through official means. It's a flight to safety.
And looking at what kind of crypto is moving tells us even more, doesn't it? The Yellow Card report was really clear on this.
Crystal clear. Stablecoins now make up about 43% of all crypto trading volume across Sub-Saharan Africa. And Nigeria alone accounts for something like $22 billion of that stablecoin volume in just 1 year.
22 billion in stablecoins.
Wow. And what really stands out, what flips the narrative, is how people are using them. We thought crypto was all about, wild speculation, trying to get rich quick. This data shows the exact opposite in this context.
Yeah.
Yellow Card's data shows that 99% of its transactions involve stablecoins. And USDT, Tether, is the absolute favorite. It's like 88.5% of their stablecoin volume.
Okay, almost everything is stablecoins, but why? Are people just rapidly trading USDT back and forth?
No, absolutely not. And here's the real kicker, the crucial insight. Roughly 70% of those Yellow Card users say they use these tokens specifically for personal remittances, sending money to family, or simply for savings.
Savings. Just holding it.
Yes. Think about that. For the average person who's watching their local currency just crumble, USDT isn't some speculative bet. It's their conservative savings account. It's just a place to park their money safely, digitally, until they need it next. Like how someone in the U.S. might use a boring money market fund. Just stability.
That completely reframes it, doesn't it? It's not an investment vehicle. It's become basic financial infrastructure, a safety net.
Exactly. And if you've got $22 billion worth of transactions in a year being driven purely by necessity and savings, well, then we need to understand the mechanics. How does this actually work? How do people on the street turn their, say, Nigerian naira or Kenyan shillings into these digital dollars without using a bank? We should talk about the plumbing.
Right, the actual how-to.
It seems to be a pretty efficient, decentralized system built on 2 main things, peer-to-peer trading, P2P, and then these localized fintech integrations.
Okay, P2P first. What does that mean in practice?
It means people are buying USDT directly from other individuals, not from big institutions or exchanges in the traditional sense. They're using platforms often integrated into the larger exchanges like Binance P2P was before some recent changes.
So I could use my phone, find someone selling USDT, send them Naira through my local bank app or mobile money, and they release the USDT to my crypto wallet.
That's exactly right. The platform usually acts as an escrow service, holding the crypto until the fiat payment is confirmed. This lets users trade their local currency for Tether at rates determined by the market. And crucially, these rates often reflect the real street value of the dollar, not some artificially low government rate.
So it bypasses the whole restrictive banking system and the official exchange rate bottleneck.
Totally bypasses it. And then, once they have the Tether, how do they actually use it? How do they cash out back into local currency when they need to buy groceries or pay rent?
Good question. That's where the fintechs come in.
That's where the local startups are crucial. Companies like Yellow Card, which we mentioned, or Bitnob, Bunded. These platforms provide the instant on-ramps and off-ramps. They act as the bridge, the Rubicon, as one source put it.
Connecting the blockchain world to the local payment systems.
Exactly. They connect that Tether sitting on the blockchain directly to established mobile money systems like M-Pesa in Kenya, or to local bank accounts. This creates high liquidity. It makes it easy to get your money in and out quickly.
And we have real-world examples of this making a difference, right?
You do, yeah. Cointelegraph reported on Kenyan freelancers, people doing online work for international clients. They're invoicing their clients in stablecoins, often USDC in this case.
Okay.
And then they use one of these local fintech platforms to receive the payout directly into their M-Pesa mobile money account, sometimes within minutes. Think about the efficiency gain there compared to waiting days or weeks for an international wire transfer through traditional banks with all the fees involved.
Incredible. And for businesses.
Same principle. We heard about Nigerian traders who now keep their working capital, the money they need for day-to-day operations in USDT. Why? To avoid the risk of waking up one morning and finding the Naira has crashed again, wiping out, say, 20% of their capital overnight. Holding USDT protects them from that volatility.
And this isn't just big players, right? Chainalysis had data on transaction sizes.
Yeah, that was really telling. They looked at Nigeria for one specific quarter, and they found that basically every single transaction under $1 million, so think retail, small business size, every single one was conducted using stablecoins.
Wow. All of them under $1 million.
All of them. And that volume, just in that segment, totaled about $3 billion for the quarter. That's probably the clearest evidence you could ask for that this is the everyday economy, the small-scale commerce, operating in digital dollars out of sheer necessity.
Okay, so a massive shift in Africa, driven by necessity. But this trend, this sort of informal digital dollarization, it's not just an African story, is it?
No, not at all. It's really a global phenomenon, a response to monetary instability wherever it pops up. And we're seeing it hit Latin America just as hard, if not harder in some places.
The numbers back that up too, don't they? Chainalysis, again, noting that 4 Latin American countries rank among the top 20 globally for what they call grassroots crypto adoption.
Right, which means adoption driven by ordinary people, not just big institutions or traders. And it's the same underlying story. A fundamental lack of trust in local currencies and economic policies is driving people to seek alternatives, and crypto, especially stablecoins, provides one.
Can we connect that to specific crises in LATAM?
Absolutely. Look at Argentina. We all know about their struggles with inflation, recently soaring over 100%. I mean, can you even imagine trying to run a household budget or plan for the future when your money loses half its value every single year?
Yeah.
Or even faster?
It's almost impossible to comprehend, so it makes perfect sense they'd flee into anything perceived as stable.
And they are. Stablecoins absolutely dominate the local crypto trading scene there. They make up something like 61.8% of Argentina's total crypto transaction volume. Now compare that to the global average, which is around 44.7%.
Significantly higher in Argentina.
Way higher. Reports show Argentinians piling into USDT, especially Tether again, literally every time the peso takes another nosedive. They treat it less like a speculative investment and more like a financial lifeboat, just trying to preserve whatever value they have.
And we saw a similar pattern in Venezuela, right, as the Bolivar essentially collapsed.
Yeah, Venezuela is another stark example. The currency became almost worthless. So the population fled into whatever they could Bitcoin saw use. But also stable coins became hugely important. It resulted in something like 110% year-over-year growth in crypto inflows. People were desperate.
And didn't the Venezuelan government try their own digital currency, the petro?
They did. That's a fascinating case study. The government tried to force this centralized state-backed token, the petro, supposedly backed by oil reserves, onto the population. And it was a spectacular failure. People just didn't trust it, didn't use it.
They overwhelmingly chose the decentralized, dollar-pegged alternatives instead.
Exactly. It speaks volumes, doesn't it? But the demand for a trusted, resilient store of value that's perceived as being outside of the government's direct control and manipulation.
So this surging demand, particularly from these emerging markets facing instability, it's a major force driving the global growth of the whole stablecoin sector.
Oh, without a doubt. You look at the total market cap for stablecoins, it jumped from maybe $5 billion back in early 2022. Estimates suggest roughly $300 billion by late 2025.
300 billion, that's astronomical growth.
It really is. And while, sure, some of that is DeFi speculation and trading in developed markets, a huge chunk of that growth is clearly driven by this practical, everyday use case in emerging economies. It's not Silicon Valley hype driving it, it's global necessity.
Okay. Which brings us nicely, I think, to our final segment, the required market snapshot that helps frame our weekly Stay Wired recap. It gives us the real-time context for this ongoing flight to stability we've been talking about.
Yeah, the volatility we've discussed, it's not historical, it's ongoing. The source data shows it clearly.
All right, let's quickly run through some key FX data points from the past week or so.
Okay, so looking at Africa, the Ghanaian cedi actually firmed up a little bit this past week, which is good news for them. But, and this is the key context, it still holds a massive year-to-date loss of about 43%, minus 43%.
You're making it Africa's worst performer this year.
By far. And when your local currency performs like that over a year, it's hardly surprising people are desperately seeking alternatives like stablecoins, right?
Absolutely. And the Nigerian Naira, which has been central to our discussion today.
The Naira actually slipped slightly, about 0.7%, just week to date. And the report suggests this was due to renewed concerns about the FX backlog.
Remind us what the FX backlog is.
Right, so that's basically the queue, the huge pile of unpaid dollar requests from businesses and foreign investors who are waiting for the central bank to actually release the US dollars they need. When that backlog grows, it signals ongoing scarcity.
Which just reinforces the problem driving people to alternatives like USDT on the P2P market.
Exactly. Although it's worth noting, despite that recent slip, the Naira is actually still up about 4% year-to-date overall. That's thanks to some earlier policy moves and interventions that had a positive effect. So it's a mixed picture, but the underlying pressure is still there.
Okay. And further south, the South African rand.
The rand fared better recently. It appreciated about 0.5%, 0.51% week-to-date. And that seems to be largely buoyed by higher prices for the commodities South Africa exports.
Providing a bit more stability there.
Yeah, that relative stability is crucial. It helps explain why South Africans, while certainly using crypto, might feel less compelled towards stablecoins as a daily necessity compared to people in, say, Ghana or Nigeria right now.
Got it. Okay, let's quickly touch on commodities then, because that search for safety plays out there too.
It does. Oil saw a bit of a recovery. WTI crude settled around $61.14 a barrel. That came after OPEC Plus announced a production increase, but it was smaller than the market had feared, so there was some relief.
But the real safe haven action was in gold.
Oh yeah, gold continued its really strong ascent. It's being driven by that persistent safe haven demand, exactly the same kind of underlying fear or caution that pushes Argentinians into USDT. It's fueled by geopolitical worries, uncertainty about U.S. interest rates, potential cuts, all of that.
And the price reflects that demand.
It certainly does. Gold was trading up around $3,988 per ounce at the end of the week. That's a pretty healthy weekly gain of about 2.2%. So yeah, the search for safe havens, whether digital or physical, is definitely a major global theme right now.
Okay, so bringing this all back together then, the shift we've been discussing, it feels undeniable, doesn't it? It's like this quiet, almost invisible, decentralized revolution happening in financial access.
It really is. I think the core insight, the main takeaway here is that for millions of the world's savers in vulnerable economies, USDT and coins like it have quietly become their new dollar accounts.
Not seen as high-risk bets anymore.
No, not primarily. They're seen as practical, simple tools. Tools that let them bypass national systems that are failing them, either through inflation or restriction.
Yeah.
And this massive shift, which the data clearly shows, is fundamentally redefining what savings even means in some of the world's most unstable monetary environments.
So, thinking ahead, what does this all mean for the future? We know the big financial players, the tech firms, they're not ignoring this. They're racing to integrate stablecoins into mainstream payment systems, basically acknowledging their utility.
Right. And at the same time, governments aren't standing still either. They see this happening and they're pushing their own response. Central bank digital currencies or CBDCs.
Which sets up a really interesting potential clash or maybe coexistence.
Exactly. And it raises, I think, a really important question, one that gets right to the heart of this whole trust issue we started with. If stablecoins like USDT became the de facto digital dollar in these emerging markets, precisely because people lost trust in their local central banks and monetary authorities, what happens when those same central banks finally roll out their own official digital currencies?
Will people trust an official CBDC issued by the very institution they were trying to get away from?
That's the question, isn't it? Will an official e-Naira or digital peso actually solve the underlying trust problem that drove people to the private, decentralized alternatives in the first place? Or will people stick with what they've found works for them, despite the risks?
That is definitely something for all of us and for you listening to mull over. A really provocative thought.
Something to watch closely as this space continues to evolve.
Absolutely. Well, that's the perfect place to leave it for this deep dive. Thank you, as always, for diving into the sources with us.
My pleasure.
And we really encourage you, the listener, to explore the full data set and the sources linked in the weekly Stay Wired recap. Until next time.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap,